All right. So, Jim, welcome back to Phase. How are you? Nice NFT. I bid 500 grand for the NFT of Jim Carroll. Anyone
Done.
else? Okay. All right, man. Yeah, I'll wire it to you today. I was going to lend some money to Donald Trump to help him with his bond, but I'd rather have your NFT. So, what do you have for us today, Jim? VIX, kept holding with the market making new highs, and today looks like it's finally giving up the ghost.
Yeah.
So a year of no fear.
Yeah, I'm gonna rip through a deck that I prepared at the end of the year.
Okay.
And there are a couple of places where I'll highlight current conditions. But the gist of it is that last year was a nothing burger from a volatility standpoint.
Yeah.
We had one little blip that we'll see, but essentially nothing happened. Um, you know, we had the regional banking collapse in 2023.
Mhm.
Startling, but it was resolved over a single weekend. We saw VIX at its lowest close since pre-COVID. And no surprise, realized vol was very low, kept VIX in check. A lot of continuing talk about zero DTE and ETFs that sell options. Um, and meanwhile, volatility was actually hiding out in the bond market as opposed to the equity
Yeah.
market. We'll get there.
Good point.
So this is the grand scale going back to the beginning of 2020, and we've just continued to sort of drift to lower ranges over the ensuing years, color coded, but right now, really kind of no fear. If you look across the equity indices, what's interesting is you do see a spread with the S&P vol being the lowest. This is as of the end of the year, but it's pretty much in the same sequence anyway. Vol on the NASDAQ 100 higher, as you would expect, and vol on the small caps, again, even higher. The small caps can't seem to get out of their own way. And the volatility there is higher than NAS 100, higher than S&P 500.
Okay.
Just a little, map of last year. Again, we had that sharp but brief spike in volatility in March, and then, a little mini surge associated with the October lows, but VIX barely broke 20 during that time period. And for a lot of people, 20 seems to be a bright line. I don't know that it's a bright line, but certainly, and Dean Kernett from Macro Risk Advisors is wont to say, nothing bad happens with a VIX below 20. And, that's probably a good way to think about it.
You
Number of
mentioned
days.
someone on your last interview that had 28 as being an important level. That means more than just a round number like 20. Do you recall?
That's funny. Dale, I don't recall that. I may have said
Yeah,
it.
you did. Because I'm an
But yeah,
elephant.
I would say that 25 is probably more important than 20, 28, 30. When you
Yeah.
get up into those levels, people think that you want to hedge when VIX is low, and that certainly when VIX is low, the cost of hedging tends to be lower. But and we'll come to some visuals a bit later. Um, you know, those hedges aren't necessarily going to do you any good. Just because you buy something when it looks cheap doesn't mean that you're getting good value. So,
Yeah, you ever
hedging.
buy anything at the dollar store? You bring it home. It's cheap. You bring it home, it breaks.
Exactly. Maybe even before you get it home.
Yeah, you hit a bump in your car in your car. Yeah, go
So,
ahead.
2023 showed the fewest days with VIX above 20 since 2019.
Wow.
So far in 2024, guess what the number is? 0.
Yeah,
We have not had VIX close above 20 in, the first,
3 months.
almost the
Yeah,
first quarter.
yeah,
So, no fear. This is slightly updated from the end of the year, but it shows using the SIBO term structure what happened in March of last year when we freaked out about the regional banks. But then if you look at the average for 2023, which is the blue, it was pretty relaxed. And as of yesterday's close, thank you, Chair Powell, we're lower left to upper right with everything below 20. So, there's no fear out there right now.
Would you say, is there any way to extrapolate no fear to euphoria? Because there may be
Well,
no
they
fear, but the
they
market
do
may
kind
not
of
be euphoric either.
they do kind of go together. You know, I feel as though we're in one of those periods where um, people keep looking around the corner for something to be disruptive, and that something just refuses to show up. There are a host of reasons that we might suspect more volatility. We might suspect some kind of correction in equity markets. But whatever concern we have fails to
Yeah,
inspire that pullback.
that's the bull market is anything that can go wrong doesn't, and the bear market's anything that can go wrong does.
Yeah,
So, it's a pretty good definition. I mean, it has shaken off everything,
certainly has.
shipping lanes in the Red Sea,
Yeah.
possible expansion of the war in Israel,
Hmm.
Ukraine not getting arms. I mean, all the geo stuff has been, completely had no effect.
Right.
You think the presidential election will?
Well, we can touch on that.
Okay,
Let me rip through a few more of these.
okay,
Again, VIX spent 2023 in a smaller range with a lower average and a lower low. Um, One of the things I look at is, if the VIX is how responsive is the VIX to a 1% change in S&P in the last 2 years. And there are people who will say that this is partly due to, front loading the options activity. And it could be. But there are also reasons to think that the VIX is doing just fine. But certainly, um, the VIX has not gone up as much per 1% down for S&P or down as much per 1% up for SPX as it has in some prior years. And so, when the S&P moves, we're just not seeing the kind of responsiveness that we might expect. People just don't seem to be, jumping every time S&P moves in the wrong direction. This is using VIX futures, same story, lower highs, lower lows, lower average. Just nobody's terribly concerned. Days in contango. This is just looking at whether the front VIX futures contract is above the second month. You know, essentially there was no contango in 2023. And so far this year, zero. not a single day with the front month above the second month.
Okay.
This is just looking at where VIX futures are versus VIX versus, realized volatility. We would expect that, VIX futures is at a premium to VIX spot, which is at a premium to realized. And, we ended the year with that, volatility risk premium intact and where you would expect it to be in, a normal or bullish market. And we're still there. I've talked about volley before with you. It is a measure of volatility that looks only at the money options. I like to look at it as sort of augmenting my perspective on what's going on out there. It's when the premium of VIX to volley gets out of line that something may be going on because there's a bid in one tail or the other. And that VIX to volley spread last year, again, lower high, lower average, just not a lot of concern. Visually, that premium is on the bottom here. The top shows where VIX is relative to volley and that quote unquote fear spread. And, it just stayed below 4 basically for the entire year. And if you see that spread rising or popping up above 5, there's something going on, because the options that are in the VIX calculation, either left tail or right tail, are being bid up relative to the at the money options. And so that's telling you that the market is beginning to price in some concern about future events. We're just not seeing it. Another one that Scott Nations and his team have developed, TDEX, the tail DEX. It's the cost of protecting against a black swan drop in the S&P 500. And, that's fell off a cliff in 2023. It just, barely got above 15 in March when we saw the regional banks concern. And, again, it got back. It's been down at pre-COVID levels basically all last year. So again, nobody wants to buy that tail protection right now. If there's no realized vol, then why should there be any implied vol? And what we saw last year was a drop in the overall levels of realized volatility. It kind of goes back to, if you look at 2017 on this chart, lowest levels ever. We're not back quite there yet, but we're staying in a fairly tight range and a very low average. 2% daily moves.
Giving up covering the VIX?
Never. Plus or minus 2% daily moves in S&P, right?
All right.
In 2017, there were 0. Last year we had 2. So
yeah.
If you have no moves in the S&P, then you've got no realized vol, you've got very low levels of implied volatility. So, we keep looking for something to shake us out of this doldrum, but we refuse. One of the other things I look at is, what's the value of protection? And this is last year. If you own the S&P 500, you finished the year up, 24%. If you invested in the S&P and bought put protection, you gave back, roughly 5 points. Yeah. And if you bought VIX options as a tail hedge, you basically cut your return in half. So you were paying for protection. The protection was not paying off. And as a result, you came out worse. So,
So for that reason, aren't a lot of people not doing that anymore?
exactly,
They call it a
it's
waste of money.
exactly. And what tends to happen historically is, when everybody has thrown in the towel on protecting their portfolios, something happens. We don't know when it is. We don't know, how it's going to arrive, where it's going to come from. But at some point in time, those people are going to need to chase insurance. And we've seen it before. The cost of insurance is going to skyrocket um, because people need to chase it. The other thing, about zero DTE is, yesterday was Fed day. So if you wanted to hedge the Fed, you had options yesterday that expired yesterday. You and I go back to the days when you'd have to go out to the next quarterly expiration if you wanted to hedge something, next week.
Right. Yeah.
Today we can target that, and that's great. But if there's a bigger event that pops up that requires protection, then all of a sudden everybody is going to be scrambling to get out, to next month or the month after that. And that's when VIX will catch a bid again.
Yeah.
So this is another perspective on tail hedges. I will not identify these two tail hedge ETFs. The one in red has announced that it's going away. But, again, putting these things in your portfolio has produced minimal positive effect. And certainly 2023 was just kind of a disaster. So this is getting to the zero DTE thing. It's a chart that people have probably seen coming out of the SIBO that, 0-day is cranking up its share of the overall volume. This is no longer a surprise to anybody. My observation is that this phenomenon has often added to intraday volatility, but also has shown some ability to dampen close to close, right, from yesterday to today. And people a lot smarter than I am seem to have drawn the conclusion that this is not Armageddon. This is not a weapon of mass destruction, but it certainly is new. The dust has not settled on how these things need to be managed or margined. And I don't know, it's something that, I'm going to continue to keep a close eye on. The other one that's gotten some headlines is this growth in ETFs that use options. A lot of options selling out there, and there's a view that the amount of option selling going on has dampened volatility. I think that's, probably true. I don't know that this is a time bomb, right? If you've got an ETF that is long the S&P and selling calls against it, I don't see the same blow up risk. People want to look at this and say this is, Volmageddon all over again. 2018, something's going to light the fuse. It's going to blow up. I don't see, with most of the structures that are contributing to this growth, where they are, creating a defined outcome. They're buying a put and selling a call. I don't see the same concern as naked selling of volatility, naked selling of VIX futures that we had in February 2018, right, that led to Volmageddon. So it's again, it's something to keep an eye on. It's important to understand the structures that are in place here. There may be circumstances where somebody is caught off sides. Frankly, I'm more concerned about the number of hedge funds that are in the dispersion trade, and that data is much tougher to come up with.
And tell our audience what the dispersion trade is.
The dispersion trade is basically looking at the volatility of the S&P 500 and the volatility of the underlying components, right? And what some people like to do is to buy the volatility of some of the underlying components and then short the index volatility to set up essentially, an arbitrage or a spread trade.
Okay.
And that's a circumstance where, you could see people running for cover if the difference in the volatilities begins to converge. If you're short the index vol and all of a sudden the index vol goes through the roof, you've got to cover that. And at the same time, you may have the vol on your underlying going the same direction, but again, you're going to have to manage that trade. It's not one where you just say, oh, hey, my call option got exercised, but I own the underlying, so there's no big deal. I've capped my return.
Okay.
Last year, if you want to see where the volatility was, it was in bonds. And anybody who is in the bond market will not be surprised that the MOVE index. And oh, by the way, it's come down, and I didn't have time to bring this current, but that's where the volatility was. And I wouldn't be surprised if we continue to see, a decent spread between the MOVE index and the VIX index, because I think there's a decent chance, with all the talk about what interest rates are going to do or not do, if we continue to see relatively more volatility in the bond market than we do in the equity markets. Just another shorter term picture of that.
Holding up so much better.
Yeah. This is, again, that what we saw when we looked at the high-low average of the VIX was, it was trending down.
Right.
And, this is going the opposite direction, which, again, for people in the bond market is not a big surprise. But I think for the average person who thinks that bonds are less volatile, well, maybe not.
So does that opinion most people have make it vulnerable because they don't have protection?
Well, I think what we saw in 2022, right, was we saw the 60/40 portfolio get, kicked in the teeth.
Right.
Because the bond piece that is supposed to be less volatile and offer some protection if the stock market fades, we saw both of them fade at the same time. And there aren't too many people still in the markets.
They
Say
had
again?
like 30 bonds, like TLT, dropped 40-50%.
Yeah, it was a rude surprise. And there aren't too many people still in the business who go back to the 70s when, this kind of behavior was last seen. We've been on the I wouldn't even call it a roller coaster ride. If you go back to, the early 80s when the Fed, when Volcker broke inflation and interest rates started to go down, it's been a dramatic tailwind to the bond market and frankly to the stock market to have those interest rates in secular decline for so long. I don't know where interest rates are going to go, whether they're going to be higher for longer, whether we're going to have a second wave of inflation that's going to cause more tightening. But it certainly feels as though that secular decline may be behind us, at least for the moment. The only way we see a dramatic drop in interest rates is if we get a real recession to show up and cause the Fed to freak out and go back to ZERP. People who are hoping for lower interest rates need to be careful what they wish for, because those lower interest rates are only going to show up if things really hit the fan. Yeah, that's my view.
Okay. Great presentation once again, Jim. It's
Yeah,
amazing
so
how, it's amazing how you can make a topic that has been pretty static interesting. That's an accomplishment in itself.
that's, these are, some of the questions that I've got on my mind. We obviously had the Fed meeting yesterday. Let's talk about the volatility of inflation, right? And the other thing that constantly amazes me is people say, well, inflation's under control, Jim. It's back to, 3% or whatever. Like, you do realize that is the rate of change that we're talking about.
Right.
Do you see prices going down anywhere?
No, just not up as much.
Exactly. So it's amazing. And the only people I hear saying that are people who have enough money that, they sort of don't notice.
Yeah. Yeah.
Which is
Most of
too
us
bad.
do. Most of us
Anyway,
do.
that's it, Coach.
Jim, great, man. Really appreciate you coming here. We've been talking for a few years now, and so I want to thank you for educating us, about the intricacies of VIX. And, it's like everything else. The minute people give up on it is when it's going to come back into vogue. The VIX is broken because of, one-day options and all of that. But, um, you know, every dog has its day, and the VIX will have its day as well. And really, thank you, my trading warrior brother, for coming into face and edifying our community. Appreciate
My
it.
pleasure. Truly.
Have a great 2024 with a couple of spikes. Let's spike it up. All right, Jim?
Let's do it.
All right, Jim Carroll, you can follow Jim on X at the VIXologist. And do you take questions, Jim? If people DM you?
Absolutely.
Okay, so I know that a lot of people may want to learn about it. Also, the new firm that you're with, they could find you there, or you prefer
Yes.
okay. And
Ballast
the name,
Rock Private Wealth.
what is it? Once more.
Ballast Rock Private Wealth.
Okay. All right. Private wealth is, I think, a great term. A very wise man said, Dale, make your money in a closet. Don't flash it. Do it in the closet.
Try
So
not to
thank
be
you,
too
Jim.
flashy.
Yeah.
You're welcome.
Thanks.
Cheers.
All right, Jimmy. Take it
Bye.
easy, buddy. So everyone, that's a wrap for Face today. We'll wrap it up with TGIF tomorrow. Good hunting. Hope we're adding value to what you're trying to accomplish in a tough game. And don't just count your pips, count your blessings. Adios.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.